Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. U.S. market analysis, structural pressures, index technicals, and semiconductor dynamics. This video presents a direct informational narration of the source document. So what we're looking at today is a really detailed, top-down explainer of the current market environment. We're going to start all the way up at the broad macroeconomic level and work our way down to the highly specific systemic mechanics and micro-level technicals. We'll be diving into recent sector divergences, those complex structural selling pressures that are currently converging on the market, and of course the geopolitical and supply chain catalysts shaking up the semiconductor space.
Okay, so here's our agenda for this explainer. 1. Market overview and breadth. 2. June PMI data. 3. Semiconductor dynamics. 4. Structural selling pressures. 5. Index support levels. And finally, 6. Micron options pricing. Let's jump right in.
Section 1. Market overview and breadth, focusing on sector divergence. Right off the bat, the broader market is showing a pretty notable split. You've got the NASDAQ 100 taking a drop of over 3%, but at the same time, the Dow remained relatively stable. This stability in the Dow establishes a really clear divergence between the tech-heavy indices and the more traditional, defensive segments of the market.
When we actually compare technology to those defensive sectors, a very specific pattern emerges. Tech obviously got hit with heavy selling pressure, but here's the catch. 11 out of the 12 tech stocks that fell 8% or more were previously up double digits year to date, with most actually up over 100%. Meanwhile, defensive sectors like consumer staples, real estate, healthcare, and utilities saw some really solid gains. So what does this tell us? It reflects a sector rotation and profit-taking in previously overextended assets rather than some kind of systemic market collapse.
To put that into perspective, just look at this number, 286. Despite the steep drops in those high-profile tech names, market breadth actually expanded. Specifically, 286 stocks advanced in the S&P 500, compared to only 216 declining. That data point really reinforces the idea that investors aren't just blindly dumping equities, they're simply re-evaluating specific, highly appreciated sectors.
Moving on to Section 2, Inflation Indicators, specifically looking at the June S&P Global PMI. This serves as a really critical secondary indicator for where inflation is heading.
And well, the June figures are notably elevated. The manufacturing PMI hit 55.7. That's a 49-month high. Services reached a 4-month high of 51.3. The composite PMI ticked up from 51.5 to 52.2, and the output index spiked to 57.7, marking a massive 59-month high. These numbers are basically telling us that persistent cost-level inflation is hovering near 4-year highs. But, and this is a crucial constraint to keep in mind, the data collection period was only from June 11th to the 22nd. Because of that specific window, the data might not fully reflect the drop in energy prices that happened right after. So we might see some adjustments next month, but yeah, inflation remains a persistent factor for sure.
Next up, Section 3, Semiconductors, Supply Chain Dynamics, and Geopolitical Catalysts. We're shifting our focus to some specific geographic triggers, specifically looking at the massive volatility coming out of the South Korean semiconductor market.
The core of this geopolitical disruption really centers around some unconfirmed supply chain reports regarding SK Hynix. These reports suggest a potential slowdown in the production ramp-up of high-bandwidth memory, specifically Generation 4. According to the rumors, capacity is actually being shifted back toward general memory. Why? Well, general memory is currently yielding profit margins roughly 15% higher than the high-performance AI memory. Naturally, the market interpreted this potential shift as a big red flag, signaling that the explosive demand expectations for AI infrastructure might just be slowing down.
And these disruptions feed directly into structural market risks. The South Korean market has these extreme leverage dynamics that really accelerated the global semiconductor sell-off. First off, MSCI actually denied South Korea developed market observation list status precisely because of this high volatility. Second, regulators are directly concerned over the rapid expansion of single-stock leveraged SK Hynix ETFs. Third, we saw direct presidential warnings regarding the wealth effects of stock market volatility. And finally, margin debt hit a record 38.5 trillion Korean won. That's roughly 25 billion US dollars. With positioning that concentrated and deeply leveraged, when those HBM rumors hit, forced liquidations just rapidly accelerated the downside.
Which brings us to Section 4, Structural Selling Pressures and Converging Liquidity Risks. Let's break down the mechanics of 3 converging waves of systemic selling pressure that are threatening to form a combined force against the market.
So there are three distinct mechanical pressures converging right now. Step 1 is a rare historical technical signal triggered by the QQQ. Step 2 is the massive quarter-end pension rebalancing that's looming over us. And Step 3 involves the imminent mechanical selling thresholds of CTA, or Commodity Trading Advisor algorithms.
Let's look at that first structural pressure. There's a highly specific historical signal at play here. A 2% gap down in the QQQ occurring when the index is within 2% of a 52-week high, while the VIX remains below 20. Both of those conditions must be met. This exact scenario has only happened 5 times in history. Before prior occurrences, May 2019, January 2020, February 2020, and January 2022. And across all 4 of those previous instances, despite a little short-term volatility, the signal was followed by a significant 1-month drawdown. When you add the high leverage present in today's market, it acts as a major catalyst, really amplifying this mechanical risk.
The second and third pressures are deeply quantitative. The June quarter-end pension rebalancing requires a mechanical sell-off of equities to purchase bonds, and that is estimated at a massive $100 billion. At the exact same time, we have the third wave, CTA algorithms. Because the market has been running so hot, these algos haven't triggered yet. However, specific downside support levels are getting dangerously close to their trigger points. If those levels are breached, these algos could be forced to mechanically liquidate 80 to 90% of their long equity positions. That would absolutely add fuel to the fire. Section 5. Index technical support levels and downside targets. Transitioning to the micro-execution layer, let's look at some highly specific, actionable support targets for key indices. This will help us figure out if the market is just undergoing a standard pullback or if it's a true structural breakdown.
Okay, looking at the critical downside parameters. For the SPY, the cited midpoint of post-earnings volatility sits right around 73.65, with key downside support zones identified at 67.60 to 69.50 and lower down at 6300 to 67.20. For the QQQ, it would actually require an additional 3% drop to break its current trend. Its critical lower zones span from 694 to 721, down to 588 to 613. For the semiconductor index, the SOXX, it absolutely must hold the 554 level to prevent a structural trend breakdown, which would require roughly an 8% drop to trigger. Finally, the SMH ETF shows support zones at 591 to 613 and 557 to 581.
Providing a bit of context to these technical levels reveals a pretty major discrepancy. During the sharp drawdowns in highly leveraged, high-multiple broader tech names, the top 4 mega-cap tech stocks remained highly resilient. They were relatively unaffected, even as the Nasdaq 100 dropped over 3%. This directly indicates to analysts that the current sell-off, as sharp as it is, lacks complete across-the-board market capitulation.
Section 6. Micron earnings and options pricing extremes. Finally, let's examine the extreme speculative positioning happening in the options market ahead of Micron's critical earnings report.
The implied moves here really highlight the sheer scale of volatility being priced in right now. Using a base price of $10.50, the weekly options expiring June 28th are pricing in an implied move of plus or minus $140. That is roughly a 15% swing, projecting a range between $850 and $1,200. And it gets even more extreme. The monthly options expiring July 17th price in a massive swing of plus or minus $240, or greater than a 20% move. That establishes a projected trading range between $750 and $1,300 within a very short time frame.
This extreme volatility expectation is totally mirrored in the open interest data. We're seeing heavy call open interest at the 1100 and 1200 levels, while heavy put open interest sits far lower at 730 and 620. This highlights a severe imbalance. Massive capital is currently being deployed into protective put strategies rather than chasing upside momentum. Furthermore, the technicals show upside support zones clustered between 778 and 1085. But here's the kicker, there's a critical support void below the 778 level, meaning if the price drops past that point, there's almost no structural support to catch it until the mid-500s.
So what's the ultimate takeaway from all of this? Well, as the source text notes, underlying AI infrastructure spending remains a foundational market driver. The current disruption represents shifting efficiency models and unwinding leverage, not a systemic failure of the core thesis. Ultimately, despite the forced liquidations, algorithmic thresholds, and sector rotations, corporate AI capital expenditure is still the fundamental driver of this cycle. The thesis remains intact even as the mechanisms of delivery adapt. Which leaves us with the ultimate question:
As these massive pools of mechanical liquidity collide, will the foundational AI thesis provide enough structural support, or are we on the precipice of a much deeper algorithmic repricing of risk?